When a self-sustaining financial loop reaches the limits of leverage, it doesn't slowly wind down, it violently reverses, crushing the balance sheets attached to it. By July 2026, the macroeconomic pressure on digital assets reached a breaking point. Market data revealed that at least 20 publicly traded companies had abandoned or severely restricted their digital asset accumulation strategies. Looking at this industry report headline, the capitulation was absolute for a large portion of the sector. 9 public corporations completely emptied their digital asset reserves, liquidating their holdings down to zero. These total liquidations were forced restructurings, driven by unsustainable corporate debt covenants, rather than voluntary, strategic responses to market dips. The doctrine of infinite passive accumulation, the diamond hand strategy, failed its first legitimate stress test against the rigid mathematics of corporate finance. Retail investors expected corporate treasuries to act as impenetrable inflation hedges. In practice, many of these treasuries functioned as pro-cyclical liabilities that accelerated corporate distress. The pathology that destroyed these companies comes down to a single error in balance sheet construction: duration mismatch. Duration mismatch occurs when a corporation acquires long-duration, highly volatile digital assets and funds those purchases using short-duration, rigidly scheduled debt instruments. When capital markets tighten and the cost of debt rises, this specific mismatch transforms an accretive treasury reserve into a liquidity time bomb. To understand how the system broke, we have to look at the mathematical engine that powered the corporate crypto boom, the market to net asset value, or MNAV, premium. MNAV equals enterprise value divided by the market value of its digital asset reserve. When this ratio is greater than 1.0, the stock trades at a premium. Companies exploit this by issuing debt to raise cheap capital, immediately purchasing more digital assets. Increasing the Bitcoin per share ratio tethers the stock price more tightly to the underlying volatility of the crypto market. This predictable swing in equity value creates high implied volatility in the options market, attracting institutional arbitreurs who profit from hedging these price fluctuations, a strategy known as gamma trading. This leveraged accumulation engine only functions while spot asset prices rise and capital markets remain open for continuous debt refinancing. In early 2026, the macroeconomic regime shifted. Spot prices contracted 50%, falling to the $63,000 to $65,000 range. That drop destroyed the implied volatility that equity investors were paying for. The mathematical consequence is immediate. The MNAV ratio collapses below 1.0. The equity premium evaporates, slamming shut the window for capital raises. Then the companies hit the debt wall. The historical bonds used to fund treasury purchases suddenly reach their fixed maturity dates. Institutional note holders exercise their put rights. Seeing the depleted equity value, they refuse to convert their debt into shares, demanding hard cash repayment instead. Pure-play digital asset companies generally lack operational cash flow to cover these calls. To satisfy their creditors, they are forced to sell their treasury reserves into a declining market. The structural leverage originally intended to squeeze the spot market upward forces a systemic liquidation cascade. UK-based Satsuma Technology illustrates exactly how this math plays out for a small-cap treasury operator attempting to replicate mega-cap leverage without the necessary balance sheet depth.
At the peak of the 2025 market, Satsuma funded its aggressive treasury expansion by securing a $218 million convertible note from institutional investors. Reading through this breakdown of the mechanics of forced selling, the timeline is clear. When the spot price dropped, Satsuma's stock plummeted over 99%. Trapped in a massive valuation discount, note holders demanded immediate cash repayment. The company had no alternative. Shareholders voted for total liquidation, dumping 668 Bitcoin for roughly $43.5 million to satisfy the remaining debt and prepare for a delisting from the London Stock Exchange. Satsuma was not an isolated case. Genius Group faced a similar fate, forced to liquidate its entire treasury simply to repay an $8.5 million debt covenant it could no longer service. For small to mid-cap operators, holding volatile collateral against rigid institutional debt guarantees, insolvency during a bear market. The mega-cap operators avoided bankruptcy, but they did so by abandoning their rigid accumulation policies and engaging in defensive financial engineering. Mara Holdings executed a defensive maneuver. The mining giant formally rewrote its corporate policy to allow strategic reserve sales, offloading 15,133 Bitcoin for $1.1 billion.
Mara used that cash to opportunistically repurchase its own convertible notes at a discount, permanently retiring with dilution risk and deleveraging its balance sheet. Even Strategy, the largest corporate holder in the world, abandoned passive holding. They restructured their treasury into a dual-leg macro carry trade to protect their capital structure. The first leg focuses on active liability management. Strategy sold 3,620 Bitcoin to generate cash-protecting dividend yields. The second leg utilizes zero-interest debt to purchase short-duration U.S. Treasury bills, locking in a profitable yield to generate operational cash flow. For the megacaps, survival required replacing rigid asset hoarding with active management of their liabilities. The post-2026 landscape demands that corporate treasuries move away from blunt force leverage and adopt precise, interlocking financial mechanisms. The first rule of this maturation is capital structure matching. Corporate leverage must be duration matched, ensuring that long-term assets are not exposed to the sudden redemption windows of short-term debt. The second rule is the use of derivative risk overlays. Surviving firms now deploy off-chain strategies, writing covered calls against their spot assets to generate the operational cash flow required to service their debt. Digital assets can no longer be treated as a simple balance sheet expansion hack. They require institutional-grade financial engineering to maintain without triggering a collapse. The 2026 liquidation wave eliminated structurally flawed, over-leveraged corporate treasuries that were built entirely for bull market conditions. The defunct companies operated as little more than leveraged equity tokens. The survivors operate as sophisticated macroeconomic arbitrageurs, actively balancing yield spreads against volatility. The industry has transitioned from a period of speculative accumulation into an era of calculated institutional infrastructure. In the coming decade, corporate dominance will belong to those who treat digital assets as components of a complex financial engine, mastering the mathematics required to survive the very volatility they seek to capture.